In our strategy, we use a 5-phase cycle framework. We do not predict headlines. We track signals and sequence risk as conditions evolve. This video highlights a signal that tends to move early, not a collapse call, but a growing pressure point we take seriously. We are reviewing Gareth Soloway from Verified Investing. He focuses on long-term technical structures in currencies and rates. Our role is to translate that signal into our strategy framework. The core claim is that the US dollar is testing major long-term support. Repeated tests increase the probability of a breakdown. At the same time, other major currencies are strengthening. In our strategy, this falls into dollar funding stress. It also links directly to yield direction, and it connects to global trust and balance sheets. This is happening because debt and trade friction weaken confidence. When confidence weakens, investors demand higher yields or diversify away. That usually pressures the currency and tightens conditions. The dollar is not just a currency, it is global collateral. When it weakens structurally, everything else reprices around it. Direction is downward pressure on the dollar. Magnitude is large for a short time frame in currency markets. Relationship shows rising yields alongside a weaker dollar. Implication is uneven tightening, not relief. The video highlights rising 10-year yields. This is happening because Treasury supply is growing while buyers hesitate. When that happens, yields rise even without rate hikes. This matters because lower policy rates do not guarantee easier conditions. If long yields stay high, refinancing becomes harder. That is how credit stress builds quietly. The euro, pound, and Canadian dollar breaking higher together matters. This is happening because dollar demand is softening globally. When multiple currencies confirm, probability increases. This setup aligns with late Phase 1 drifting toward Phase 2. Markets can still rise, but fragility underneath increases. Highly leveraged borrowers feel this first, then housing and private credit, then equity multiples before earnings decline. This is why high beta growth becomes fragile. This is why long-duration bonds do not automatically work yet. This is why gold behaves as insurance, not a timing tool. Quick note before continuing. This is educational macro commentary only. It is not financial advice. Dollar downside risk has increased. Yield pressure is no longer theoretical. FX confirmation strengthens the signal. This does not confirm a dollar collapse. This does not invalidate short-term equity resilience. This does not trigger forced action yet. We tighten exit discipline. We respect cash as optionality. We wait for forced liquidity evidence before acting. Over the next few months, Phase 1 can persist with higher fragility. Over the next half year, Phase 2 risk rises if yields stay elevated. Later, risk depends on credit confirmation. This is happening because debt and trust interact. When debt rises faster than confidence, currencies wobble. And when currencies wobble, systems reprice. We do not need to be early, we just cannot afford to be late.